Ethan, would you suggest the Job Guide 360 guide for candidates getting ready for interviews?
Yes, without a doubt. It is well structured and makes preparation straightforward.
Welcome to the deep dive. Ever wonder about that person, in the financial world? The one who seems to just know why one stock's a maybe and another's a definite buy.
The Equity Research Analyst. That's them.
Exactly. They're kind of the analytical powerhouses behind a lot of big investment moves.
Yeah, it's a role where you really need to bridge the gap between deep technical work like spreadsheets and the bigger strategic picture. These analysts essentially provide a roadmap for investors.
A roadmap built on, intense market study and some serious analytical chops.
Precisely. They blend those to create insights you can actually act on.
Okay, so today, our sources are sort of lifting the veil, giving us a look inside their playbook, the methods they use day in, day out.
It's like a shortcut to understanding their core knowledge.
Right. So our mission then is to unpack those foundational methods, get into the nitty-gritty of how they value companies, and understand the mindset of a top analyst.
Exactly. If you want to know how the pros really assess value and risk, well, you're in the right place.
We're aiming to go beyond just listing formulas, though.
Definitely. We want you to grasp how the best analysts apply these tools, why they pick certain metrics, and what makes an analysis truly insightful versus just surface level.
Okay, let's dive in. So before an analyst even touches, say, a financial statement, they need some kind of strategic base, right? A framework.
Absolutely. It starts with the non-numerical side, setting the stage for all the numbers that come later.
And the first big tool our sources point to, emphasizing the rigor needed, is the SWOT analysis. Strength, weaknesses, opportunities, threats.
Right, SWOT. It sounds basic, maybe, but for serious analysts, every single point needs to be backed up. It can't just be vague ideas.
So, good brand recognition isn't enough on its own. How do you make that solid for an investor?
You have to tie it to something measurable. So a strength isn't just that, say, Apple has a strong brand. It's that Apple can maybe charge a 30% premium compared to its rivals, something you can actually see in their gross margins versus competitors.
So it's quantified.
Exactly. And weaknesses, too. High debt isn't just a statement. It's tied to a specific, maybe worrying debt-to-equity ratio compared to the industry average. Or a weak supply chain shows up in lower inventory turnover numbers.
Got it. That turns it from just a strategy point into something financially concrete, looking both inside and out.
Precisely. Opportunities might mean putting a number on the size of a new market they could tap into. Threats, things like new regulations or, geopolitical issues get modeled against potential revenue hits.
The rule being,
if you can't back it up with data, ideally quantitative data or industry benchmarks, it probably doesn't belong in a serious analyst report.
Okay, so once that detailed strategic picture is sketched out, validated, analysts then shift to comparing the company to its peers, right? The comparative company analysis, or CCA.
Yep, CCA. And getting the comparison group right is absolutely vital.
How do they make sure they're comparing apples to, similar apples?
It's about careful selection. Peers are chosen based on industry, sure, but also size, market focus, even how complex their business model is. You need genuine comparables.
And once you have the group,
then you gather the data revenue, EBITDA, net income, the usual suspects, and calculate the key valuation multiples. Price to earnings, PE, enterprise value to EBITDA, return on equity, ROE, those are the big ones.
But the goal isn't just to find the average PE for the sector, is it?
So definitely not. It's about spotting the outliers. Why does one company trade at a much higher multiple than others? Is the market genuinely expecting faster growth from them? Or is there something else going on, maybe even a bit of hype?
So the differences tell the story.
Exactly. Understanding why those valuations differ, that often forms the core of the analyst's investment thesis for the company they're actually covering.
That makes a lot of sense. SWOT for internal health and external factors, CCA for market perception and relative pricing. But, okay, great strategy, great comparisons. It all hinges on getting the math right, doesn't it?
It does.
Which brings us to the engine room. Financial modeling. Translating all this data into actual forecasts.
Right, financial modeling. This is really where the discipline kicks in.
Yeah.
And every model starts with a clear objective. Are we trying to find an intrinsic value? Assess financial health, maybe model a specific scenario.
And the main tool is still Excel, I assume.
Overwhelmingly, yes. Microsoft Excel is a workhorse because it's so flexible. but top analysts push it hard,
Yeah.
using macros, maybe even some VBA scripting to automate repetitive tasks.
Makes sense. Need efficiency, especially with constantly changing market data. They can't just wait for quarterly reports, I imagine.
No way. That's where something like the Bloomberg terminal becomes absolutely essential. For real-time data feeds, March consensus numbers, industry benchmarks, it's indispensable.
Okay, and what kinds of models are we talking about primarily?
Well, the cornerstone for intrinsic value is usually the discounted cash flow or DCF model. But analysts also use others like leveraged buyout, LBO models, especially if they're looking at potential M&A, and crucially, sensitivity analyses.
Sensitivity analyses, to see how much the outcome changes if assumptions shift a bit.
Exactly. What happens to the valuation if revenue growth is 1% lower than expected, or if costs are slightly higher? It tests the robustness of the conclusion.
Let's zero in on the DCF, though. It feels like the gold standard. And the trickiest part often seems to be figuring out the discount rate, the WACC, weighted average cost of capital. Why is that so complex?
It's tough because WACC tried to boil down the entire company's risk and financing cost into a single percentage. It represents the average rate the company has to pay all its investors, both debt holders and equity holders, to finance its assets.
And it's made up of two parts.
Yeah, essentially, you've got the cost of debt, basically, the interest rate the company pays on its borrowings, adjusted for the fact that interest payments are usually tax deductible, and then you have the cost of equity.
Cost of equity. This is where CAPM comes in, right? The capital asset pricing model. Sounds intimidating.
It can seem that way, but the concept is straightforward. The cost of equity is the return shareholders expect for the risk of owning the stock. CAPM calculates this.
How? In simple terms.
Okay, think of it like this. You start with the risk-free rate, what you could earn on a super safe investment, like a government bond. Then you add a bonus, a premium, for taking on the extra risk of investing in this particular stock compared to the overall market.
And that riskiness is measured by beta.
Right. Beta measures how much the stock tends to move up or down compared to the broader market. A beta of 1 means it moves with the market. Higher than 1, it's more volatile. Lower than 1, less volatile.
So beta captures that market-related or systematic risk, but isn't beta based on past performance? How does that work for a forward-looking model like a DCF?
That's a challenge, absolutely. And that's where analyst judgment really matters. The calculation starts with historical beta, yes, but a good analyst will adjust it based on their view of the future. Will a merger change the risk profile? Is the regulatory landscape shifting? They have to make a call.
So it's part science, part art.
Very much so. Once you have the cost of debt and the adjusted cost of equity, you weight them based on how the company finances itself, how much debt versus equity it uses, and boom, that's your WACC. It's debated, sure, but it's still the standard way to factor in both time and risk into valuations.
That complexity really highlights the depth involved. Okay, another layer. Valuation isn't one size fits all, is it? Different industries, different company stages, they need different approaches.
Oh, completely. You absolutely cannot value, say, a mature utility company the same way you value a cash-burning tech startup. The models have to fit the business.
So for those high-growth companies like tech or maybe renewables, what's the focus?
For them, you're often looking at revenue multiples, like price to sales and definitely DCF. But the key is projecting cash flows much further out. Why? Because current profits might be small or non-existent. It's all about the future potential. Growth is the name of the game.
Right. Earnings today might not tell the story. What about the other end of the spectrum? Stable, mature companies.
Like utilities, for instance. They often have very predictable cash flows and pay out a lot in dividends. So the dividend discount model, or DDM, becomes much more relevant there. It values the company based on the present value of its expected future dividends.
So something like real estate.
That often leans more towards asset-based valuation. What's the actual market value of the properties they own? So yeah, tailoring the approach is absolutely crucial for a meaningful valuation.
Okay, so we've built these sophisticated models projecting the future, but analysts also need to make sure the company's standing on solid ground right now, looking beyond just the profit numbers on the income statement.
Exactly. The balance sheet is critical for that reality check. It tells you about the company's financial stability.
What are the key things they scrutinize there?
Well, first up are liquidity ratios, things like the current ratio and the quick ratio. They basically ask, can the company pay its bills that are due soon? If those ratios look weak, it's a red flag immediately. It signals higher risk.
Which probably feeds back into that cost of debt calculation we talked about.
Yeah, it certainly can. Then you look at asset management. How efficiently is the company using its assets to make money? Think inventory turnover, receivables turnover. Are they selling products quickly, collecting cash effectively?
And the other side of the balance sheet, the liabilities.
Absolutely. You need to understand the structure of the debt.
Yeah.
Is it mostly short-term debt that needs refinancing constantly, which adds risk? Or is it more stable, long-term debt? At-risk profile is key. And analysts also look at shareholder equity over time. Is the company reinvesting its earnings for growth, or is it paying out most profits as dividends? Tells you about their priorities.
Okay, that covers the hard numbers on the balance sheet. But what about the stuff Excel struggles with? The non-financial factors. Our sources say these can be just as important, sometimes more so, for long-term success.
Well, definitely. Management quality is huge. What's their track record? Do they make smart strategic calls? Do they operate with integrity? That's assessed through, past performance, conference calls, industry checks.
And governance, how the company is run.
Crucial. Corporate governance. Is the company transparent? Are the executives' incentives aligned with shareholders? If governance looks weak or opaque, analysts might actually increase the discount rate they use, reflecting that higher risk.
What about the product or service itself? How does that get factored in?
Through things like brand strength and customer satisfaction. For a subscription business like SaaS, they'll look really closely at churn rate, how many customers are leaving. Low churn suggests stable future revenue, which makes the DCF forecast more reliable.
De-risks it, essentially.
Exactly. And finally, innovation. Are they investing in R&D? Filing patents? That's often the only way to justify assumptions of sustained long-term growth.
Right. So you've got all these company-specific details, financial and non-financial, but analysts can't operate in a vacuum, can they? They have to consider the wider world.
Absolutely not. That macro context is vital. Analysts are constantly monitoring the big economic indicators, GDP growth, unemployment, inflation. But interest rates are probably paramount.
Why interest rates specifically?
Well, think back to WACC. If central banks raise interest rates, the company's cost of borrowing, the cost of debt, goes up. And often, the risk-free rate used in the cost of equity calculation also rises. Both of those things can significantly push down a company's valuation, especially if it carries a lot of debt.
And beyond economics, what about things like geopolitics, trade wars, sanctions? That seems really hard to model.
It is hard. It's less about prediction and more about scenario planning. Analysts track international developments closely. If a company relies heavily on, say, imports from a certain region, the analyst might build a scenario. What if a trade dispute raises costs by 10%? How does that impact projected cash flows? Then they adjust forecasts or discount rates based on how likely and severe they think that scenario is.
So it's about building resilience into the analysis, testing it against potential shocks.
Precisely. It provides a more robust view of the risks.
It's really clear that being an analyst isn't static. You're constantly getting new information that might challenge your previous ideas. How does a good analyst handle, say, conflicting data? Maybe a supplier gives a different picture than the company itself.
Yeah, that happens. The key strategy is transparency and rigorous validation. First step is always to try and verify both pieces of information. Can you cross-reference with other data sources, maybe from data providers like Bloomberg, dig into why they conflict?
And if you still can't reconcile them,
then you have to make a judgment call. But critically, you document why you're choosing to rely on one source over the other, or how you're weighting the conflicting info. Transparency about that uncertainty is paramount in the final report.
Okay. And what about when things change fast? Maybe earnings guidance gets cut, or a major market event happens and your forecast suddenly looks wrong.
You have to react quickly. Time is definitely critical there. The first thing is to rerun the numbers, often using those sensitivity analyses we mentioned, to see exactly how big the impact is on the valuation and the earnings outlook.
And then communicate.
Immediately. You have to update clients and stakeholders right away about the change and what it means for the investment recommendation, the buy, hold, or sell rating. No delays.
All right, let's tackle the really tough scenario. What happens when a recommendation just goes badly wrong? The stock tanks and your analysis looks flawed. What's the process then?
Look, it happens. The first step is a really honest deep dive to figure out why. Was it something truly unpredictable from the outside? Or was there a mistake in the original analysis? Maybe a flawed assumption about growth or costs or that tricky WACC?
A kind of analytical post-mortem?
Exactly. It requires real self-correction. You update the models, you reassess the whole investment thesis based on what went wrong, and then, crucially, you have to communicate that openly with clients. Explain why the call was wrong, what you learned, and how you're adjusting your process.
So it's about owning it to maintain credibility long term.
Absolutely. Hiding mistakes destroys trust. Learning from them and being open about it builds it.
Okay, last piece of the puzzle. Communication. An analyst can be a quant genius, but if they can't explain their findings clearly, it's kind of useless, right? How do they bridge that gap between complex analysis and, say, a busy portfolio manager?
Yeah, communication's a core skill. The focus has got to be on clarity. Translating the complex numbers into a clear narrative. That means using simple, direct language where possible. Avoid unnecessary jargon.
Analogies help too, I bet.
Big time. And visual aids are incredibly important. Charts, graphs, infographics, they can convey a lot of information much more effectively than dense text or tables.
What's the general approach? Start broad.
Usually, yes. Start with the big picture. What's the main conclusion? What's the investment thesis? Then you can drill down into the supporting details, but always linking it back to why it matters for the client or the investment decision. Focus on the so what. #outro.
Wow. Okay, we've really covered the waterfront today, from those foundational frameworks like SWOT and CCA.
Right, quantifying the strategy and understanding market positioning.
To the real mechanics of valuation, wrestling with WACC, tailoring DCF models.
And then folding in the balance sheet health, the non-financials, and those big macro risks.
It feels like we've mapped out the entire analytical journey for a single company.
Pretty much. You now have a good handle on how analysts assess risk and value at that individual security level. But, the story doesn't quite end there.
Oh.
Well, our sources remind us that this all happens within the broader context of investing, often guided by something called modern portfolio theory, or MPT.
MPT, that's about diversification, managing risk across a whole portfolio, right? Not just one stock.
Exactly. It's about understanding not just the risk of one company, but how its risks relate to other investments.
So we've spent this time learning how analysts evaluate the individual tree, so to speak.
Yeah. And the final thought we want to leave you with is about the forest. Now that you understand how analysts adjust their models for, say, industry-specific risks when valuing one company, how do they then think about that security within a portfolio?
How does knowing the micro risk, like maybe a regulatory threat to one specific sector,
how does that translate into building a balanced portfolio? How do they assess how that stock might move in relation to everything else they hold to manage the overall, systematic risk?
moving from valuing the part to optimizing the whole?
That's the next level challenge. It bridges this deep company analysis with broader strategic wealth management.
Definitely something to think about. A great place to wrap for today. Thanks for joining us on the deep dive.